All of them have nice, juicy returns, as far as their projected business plans. There's a ton of operators out there once you start getting into this space, and all of their deals look good.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into another episode of the Freedom Point. We're so glad you're here with us today. I have another amazing guest, Jarod Alexander. Jarod, welcome to the show.
Jeremy, thanks for having me.
Yeah, absolutely. Good to have you here with us today. Jarod is the founder of Optimal Equity Group, which was formed to help educate investors on how to achieve strong returns by investing in real estate. Jarod's responsibilities are to bring vetted opportunities to investors offered by experienced real estate firms with a proven track record. Jarod, what inspired you to start Optimal Equity Group, and how did your background that I know you had in sales influence your approach to real estate investing?
Yeah, great question, Jeremy. So, being in sales and having that background, I got into this space probably early 2021, late 2020. And I knew I wanted to get involved in real estate, and I tried to single family and quickly learned that was not as scalable as I would have liked. So then I came across multifamily primarily apartment syndications. And I didn't even know, what that was, what that looked like. But once I got on the phone with an operator and invested in my first deal, for one, I knew, me not knowing what it was, not a lot of other people knew about this vehicle of investing either, and how they can diversify outside of the traditional stock market, bonds, mutual funds, things that we're just grown up to know. And so I'm the shout it from the rooftop type of guy. I quickly invested in a total of 6 syndications in the past 3 years, and just, again, loved this space so much that it prompted me to start Optimal Equity Group, where I could help educate others on how they can participate in these passive income vehicles.
Yeah, no, that makes sense. So how do you identify and vet the real estate firms and the opportunities that you are presenting to your investors?
Yeah, good question. So, kind of like whenever I was starting out, you got to determine this sense of know, like, and trust, right? A lot of these deals, and you probably see them too, Jeremy. They come across my inbox, and there's a ton of operators out there once you start getting into this space, and all of their deals look good. All of them have nice, juicy returns, as far as their projected business plans. But I go into, for one, track record. For two, I'm a big fact. What's a big factor for me is vertical integration, what we like to call it. So, which that means in-house property management. If some of these operators, like we know with Rise 48, they have the in-house construction too, so they have a lot more control over that asset. And not saying third party property management is a bad thing, but they're managing a lot of different portfolios for a lot of different operators. And if they got an operator with a bigger portfolio than, the one that we're invested, that we're looking at, then they're going to primarily spend a little bit more time on that. And so anyways, that sums up to, hey, if it's not being managed, properly, occupancy is not up, things like that tends to decrease the cash flow and can have a big impact on the asset itself, which impacts the investor. So my main thing is vertical integration, track record. I do look at market specific too. So, we're looking at like Phoenix, Dallas, Houston, and, Charlotte, North Carolina is another one, which I'm excited about. I'm from North Carolina originally. So, kind of the old stomping grounds there. But yeah, I mean, emerging markets, we're looking at population growth, job growth, medium household income, making sure we're checking all the boxes there. And so those are some of the top three factors we look at.
No, that's great. Can you share a story about a particularly successful syndication that you've been involved with and what made it stand out?
Jeremy, so honestly, I am, being that I got started in 2021, I haven't had a deal go full cycle as of yet, but I will share the success around that has been a huge learning curve for me. And there's been a ton of education involved in knowing, with this is a risk, right? You want to make sure you're not investing money that you don't have. Things don't always look the way you think they're going to look in a year or two. And a prime example of that was interest rates rising, early 2022, which nobody expected, nobody saw coming. And so as a result, some of those deals, have, paused distributions. But this is going back to why you invest in a good operator, right? Now, these are my personal investments as an LP, but the operator I'm invested with, they got in front of it. Their communication was great, because, when you get into these deals, you don't expect everything to go as planned. I mean, you hope it does, but there's things happen along the way, and it's how is that individual or team or sponsor going to address it. And so, what made me feel more comfortable with, the people I was invested with is they did, get out in front of it, let us know what's going on. They were very transparent about where they're at in their portfolio, why they're pausing distributions. And it made me pay attention to the debt structure of how these, how the debt was, structured with the bank. I like a lower loan to value now. That's another thing we look at. And so, yeah, I think so. The answer to that question has been a big learning process along the way, and because you don't know what you don't know until you get into this stuff, and so that's something I've been paying attention to more.
No, that's great. I appreciate that, and that really kind of leads me to ask the question, or begs the question. What are some common misconceptions that you see that investors have, as it relates to real estate, investing, and how do you typically address those misconceptions with those potential investors?
Yeah, well, it's tough when you got these investors that have kind of the mind. We're growing up, through school is, you graduate, get a job, get a career, 30, 40 years, put your money in the stock market, 401ks, max all that out. And that's just what we know, right? Retirement account, self-directed IRAs, or whatever that looks like. And then when you start talking about these alternative investments, primarily apartment syndications is what we're focusing on. There's a red flag that goes up, or their radar. Hey, wait a minute! Not a lot of people are talking about this. Is this a Bernie Madoff scheme? What is going on here, right? And you get those individuals that have had bad experience, or know their family members have, right? And so, my main thing is I just help educate people on what, from one, you talk about the benefits of real estate, right? Because and when people do hear real estate, Jeremy, they're thinking single family or flip, right? Those are the two most common, or maybe even buying a fourplex. But not a lot of them are talking about these 200 plus multifamily properties that we're investing in. But my main thing is just educating them. For one, we start from what is a syndication, what that looks like. It's like, hey, we don't have millions of dollars just sitting in the bank. So what we do is we get this, asset under contract. We get a loan from the bank. Keep in mind the bank is underwriting this as well, right? Because they're putting more than 50% of their money down on that. So just keep that in mind. And then we raise the money from investors for down payments, renovation costs, and then where they can participate in the return. So, walk them through that. And then also, this is real estate. This is brick and mortar, right? I mean, honestly, for me, I can understand this more than I can the stock markets and investing in individual companies, through stocks, is because it's more tangible to me, right? These are brick and mortar assets. I can drive by them, see them, touch them. I just went by an asset the other day. One of my first investments I did actually through a self-directed IRA that, hey, all right, they're doing renovations. They're doing what they're let's say in their monthly updates are, they're updating these specific units or updating the signs or whatever that is, right? So going through that, and then also is, why I like multifamily is, the risk mitigation, right? It's, if we all know, or a lot of us know, what houses cost, and I feel bad for the first time home buyers right now, because it's really expensive to go out and purchase a home. And so a lot of these, newer home buyers, or even, we've millennials, even baby boomers, they're transitioning more to the rental space. And so we're investing in 1980, 1990s properties, workforce housing, right? And you got, unlike a single family, if you don't have one person paying the rent, you're getting 100% of zero. Well, in a multifamily, you got a 200 unit, you got 10 people not paying the rent, you're still got 190 that are, right? So you spread risk that way. And then, we can go into forced depreciation, all that. But those are some of the key factors that I help educate others. And then tax benefits, you still get to participate in that as well. So yeah, those are some of the top ones there. Yeah.
Yeah, no, that's great. I appreciate you sharing that with me. So how do you ensure that your investors achieve strong returns while also managing the risk side with their investment?
Yeah, I mean, I think the biggest one is I'm personally invested in these deals too, right? It's like I want to make sure that this operator is going to do right by me. I want to peek behind the curtains, and even some of these deals that have paused distributions, like I'm seeing, what they're doing to ensure that I still get my capital back. So I think that's probably my answer to that is I want to make sure the operator is going to do right by what they're saying. It's so easy to put out an email and say, hey, here's the projected returns. Here's what we're expecting. But, we know, Jeremy, and I know you've gone full cycle on a few of these deals. And I mean, these are based on past performances, but a lot of these deals you're, in 3 to 5 years, and some of these were even less, you could double your money, you still get the tax benefits, you get the cash flow throughout the hold period. So it's very lucrative, and it's pretty exciting when you start going full cycle on these deals and seeing that compounding effect of what, you're talking some life-changing money at that point. So it's so yeah, we educate around that, but we again talk about the risk factor. Hey, we want to educate our investors on the risk getting involved in this, but also say, hey, it can be very lucrative too.
Yeah, absolutely. Now I know that you don't have a crystal ball, and I lost my magic 8 ball when I was a kid. So my question for you really is this, and that is, where do you think that the real estate market is headed? As we look to wrap up 2024 and move into 2025.
Yeah, great question. And like you said, Jeremy, definitely don't have the crystal ball. I was expecting, because interest rates have been a big factor in multifamily right now. That's definitely impacted our market and a lot of the economy, but especially in the multifamily space. And if you had asked me 3 or 4 months ago, I would have thought that interest rates would have gone down by now. Maybe a little bit, but I honestly wouldn't be surprised if at the end of 2024 we're right here where we're at, and interest rates are still the same. So I think we're just going to keep doing what we're doing. Making sure the underwriting fits the models that we're looking at, and just kind of go based on the numbers, because there's a ton of predictions that even the most what I should say successful or vetted economists out there, can predict stuff that just doesn't happen. So I think if you just keep it, I'm all about simplicity, right? Stick to the numbers, get the emotions out of it. If it makes sense, let's move forward. If not, let's move on to the next. So.
Yeah, absolutely. Yeah. Speaking of next, what's up next for Jarod, either personally or professionally?
Yeah, good question. So, personally, I love doing like Spartan races and stuff. So I got a big one coming up. I'm doing a half marathon coming up in November, which last year Jeremy whooped my butt. I was very humbled. I had some injuries kind of going on during that race, and took everything I could to talk about some mindset and perseverance there, man. It challenged me, but I got through it, and now my goal is to conquer that race here coming up. Just hiked the Grand Canyon, so that was a bucket list. We did a rim to rim, and yeah, just excited. My son's in basketball, so we're doing that whole deal. On the coaching, we've talked a little bit about that. So personally, that's where that at, and professionally, I'm actually looking at vetting some other operators to have a little diversification in asset classes. So I'm going to North Carolina here in a month. Actually, going to be meeting with a storage operator there, and he actually, it was kind of cool. This is the power of networking, right? Had him on my podcast. He owns a motel, and was letting me and my family stay there right off the beach, and we're gonna go grab coffee and talk about business and possibly a partnership. So, yeah, having some different diversification for my investors and the asset classes too.
Yeah, no, that sounds great. Always good to have diversified investments, and I can relate with your running story as a former recovering marathon runner myself. Can definitely relate there. So appreciate that. Yep. What would be maybe one or two different ways that our listening audience can reach out to you to learn more about what you're up to?
Yeah. The biggest way is, so I'm on LinkedIn, just Jarod Alexander, or you can go to my website, optimalequitygroup.com. I actually have a free ebook on there you can go and download. Just kind of gives you a high level of what apartment syndication is and my journey going through that. But those are probably the two best ways.
Right. Yeah, sounds good. Well, we'll definitely put those links in the show notes for our listening audience. Jarod, really appreciated you joining the Freedom Point podcast today.
Awesome, Jeremy. Thanks for having me.
Absolutely. And listening audience, thank you again for joining another episode of the Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.